Lucas.
Okay. Hi, everyone. I'm Lucas Hart. I am a certified financial planner candidate and a student in Andy Rent's coaching capability training. And today, I'm going to talk about long-term planning and why it's important for financial and family security. The title of the presentation here is a little different than what was advertised. I made it a bit broader. So in case you're confused at all. Just wanted to mention that. And to give you a heads up, in a few minutes, you're going to need your phone for a Mentimeter survey. And I'll warn you again when we get there, but if you want to keep that handy, might save you a couple of seconds in a few minutes. We have four key objectives today. We're going to define long-term care and then talk about some of the statistics related to long-term care needs and associated costs, touch on long-term care options, and then various ways people can pay for long-term care. And then at the end, there's going to be a brief calculator scenario. And after that, I'll have another broader question for all of you to engage with as well. And this is meant to be a high level but comprehensive overview to build awareness around long-term care plan. Introduce concepts that you can consider using in client conversations. Is one of the better descriptions that I found is from the National Institute on Aging. It's here on the slide, and it says, a variety of services designed to meet a person's health or personal care needs when they can no longer perform everyday activities on their own. So it's a pretty broad, encompassing definition. The Health Insurance Portability the Health Insurance Portability and Accountability Act, it's a mouthful, or HIPAA, as you heard before, has another definition of long-term care, and that says it's the inability to perform at least two activities of daily living, or ADLs, for at least 90 days. It outlines the ADLs as eating, transferring to or from better care, impairment to receive payments from a long-term care health insurance plan. However, for long-term planning purposes we're talking about today, the HIPAA definition isn't quite broad enough because the long-term care need can a variety of factors, including things called incidental activities of daily living, or IADLs. And these are not covered under the HIPAA definition, but are captured better that first definition that I heard that was broader. And these can include things like managing finances, housekeeping, yard maintenance, cooking, transportation, managing medications, many other basic necessities. And in fact, IADLs are among the common long-term care needs. And the last thing before we move next to Mentimeter survey, warning, have those phones ready. The last thing I want to mention is in terms of defining long-term care, this is not long-term care insurance. Long-term care insurance is a tool to help pay for long-term care needs. And that can be confusing when you're talking about this topic. I'm going to switch over my screens here. So if you just bear with me and get those phones ready to share a different screen. See if I can. Here are the instructions. So you scan that QR code, and then at the top, there's a code to enter, and on the left, you can see it as well. That'll appear on the top of these upcoming slides too. So as long it's going to give you a couple seconds here to scan that. And then I'm gonna advance to the first question. Have you known someone who needed long-term care? So I'm trying to get a sense of how so far have actually rising to me it looks like oh, okay, we're recording again. And then similar to considered your long-term care plan. One reason is because so we can relate to might be available to them. And pretty split here. So some people maybe a little bit, almost 50-50, yes, no. And last question is what percent of people long-term care? 10% increments, as you can see. Yeah. Some people have done some research on this. You're getting it's in the right range. Anywhere from 30% to 90%, it looks like, or 20% to 90%. Great. Okay. I'm going to stop sharing here again and switch back to the other, or back to my slides. Okay. So you kind of had a bell-shaped curve there in the survey. Landed a lot of people did select around 70 to 80%, I think it was, and or it might have been 60 to 70, I've already forgotten. But it was a high percentage and it was right in range with reality. So the Administration for Community Living has said that 69% of people turning 65 in 2020 will need long-term care and for an average of 3 years. So long-term care is a high probability event. That's the main point. What's interesting about that data is that most long-term care is provided through informal, unpaid individuals, such as family. So 90% of individuals receive at least some informal care, and 66% receive all informal care. Lost income and benefits for, lost income and lost benefits for informal caregivers is estimated at over $280,000. And that's for men. For women, it's actually higher than $300,000 because women tend to be the caregivers. They have better longevity than men. For those using both unpaid and paid care, the average length of time paid care is used is just under 1 year, about 0.8 years. And that's according to the HIPAA definition, which is a little bit stricter. So if we take that broader definition of long-term care to include incidental activities of daily living, it's probably actually a little longer than that. The reason I wanted to show this is because the data shows paid care is average of about 1 year. And we know the average of long-term care in general is 3 years. So family are about 2 years of providing about 2 years of care, unpaid care, which is a long time. So given that information, family needs to be considered in long-term care planning with clients. They'll likely be impacted both financially and psychologically. And the fact is, most people don't plan for long-term care until it's too late to mitigate for those kinds of impacts. Even if someone does receive mostly unpaid care, the average projected cost is over $120,000 in 2020 dollars. And I've just put that out in 2025 dollars at a 5% inflation rate. It's 154,000 today, roughly speaking. And 5% is actually a pretty realistic inflation rate put on long-term care costs that historically is about what it's been, depending on the type of care you look at. And looking ahead, that's what it's projected to be. For someone that's received no unpaid service, the average cost is $245,000, so over $300,000 today. So not only is long-term care a high probability event, it's also a high cost event. The earlier planning starts, the higher likelihood that client and family will be able to absorb those costs, still meet other lifetime retirement and legacy goals, and have the option of planning for the type of care that they want before it's too late. Long-term care costs can be attributed to a variety of types of care, including adult daycare, especially if family caregivers need a break during the day or have other employment. In-home care, that's for things like cooking, cleaning, transportation. Home health aides for bathing, dressing, medication. And then there's assisted living for someone who may need some personal care and health services in a residential setting and nursing home care for those who need around-the-clock care and or supervision. There's a tool online, the Genworth Cost of Care Report, that is really good for looking at how these costs vary across the country. It is quite variable across states. But just to give you a sense of what those individual costs are, adult daycare is about $24,000 if we're assuming 40 hours a week of care for a year. In-home care, home health aides, assisted living is about $70,000. And nursing home is about $120,000. And again, I'll just stress that those vary quite a bit. Aside from the unpaid care that I mentioned earlier, the costs of these services can be met through self-pay, Medicaid, and private financing. And I'm going to touch a little bit more on each of those. But before we get there, I want to note that Medicare does not cover long-term care. It will cover injury and illness related to hospital stays for a limited amount of time, but it doesn't cover long-term care as we define it here today. And this is a common misconception. So if you hear somebody saying, well, Medicare will take care of me, not necessarily true. Self-pay is pretty self-explanatory. It's just covering the costs of care directly from personal cash. But one option that may not be quite as obvious under the self-pay umbrella is continuing care retirement communities. And these usually have an upfront fee to buy into the community, and those can be very high, $500,000 in some cases. Monthly fees, and when you get into the community and pay those monthly fees, the benefit is you do have independent living and long-term care. So you can live independently, and then as you need long-term care services, you can just migrate directly into those services at the facility you're living in. As with any kind of contractual related plan like this, it's really important to know the details of the agreement. For example, if monthly fees can increase, who determines when long-term care is needed, et cetera. There's a long list of questions that you should have answered before buying into these. Medicaid is one that many people have heard of. It will cover long-term care for individuals who meet income limits, asset limits, and medical qualifications. And this can include people who spend down assets below the state's Medicaid threshold. But beware of the 5-year look back. For example, if assets were gifted or moved into a trust, et cetera, within 5 years of meeting within 5 years of needing Medicaid, they may not qualify until that 5-year period has passed. And make sure that you know the state qualifying rules, because those also vary considerably across states. And then finally, with private financing, there are many different options: reverse mortgages, annuities, trusts, long-term care insurance, both in traditional and hybrid formats. Traditional generally pays like a daily or a monthly benefit. Hybrid policies, those are attached to life insurance, so it might have like a accelerated death benefit that you can use towards long-term care expenses. Hybrid policies are tending to get a little more common now over traditional policies. One thing to watch for with this, if a client says that they have long-term care insurance, studies have shown that 29% of people think they have long-term care insurance, but really only 3 to 4% actually have it. So dig into that if somebody is raising that as something that can cover them when they might need long-term care. We could spend an enormous amount of time on this topic alone, but suffice to say the costs and benefits of each of these varies considerably. So due diligence is really important, and a combination of payment options may be needed to fulfill the client's wishes. And you can spend some time going over those with the client and talk through the benefits and the pitfalls of each one and look at what combination might work the best. One of the benefits of private financing is that it can provide some base level of support. So if they do have one of these or they can tap one of these options, it will give them something that they can rely on. Now I want to take a minute to look at a scenario, and we're going to run through a calculator here. I'm using one from seniorliving.org. I've got the link down there at the bottom. And there's many others online. I like this one just because it's simple. This can help a lot with a client to tell the story behind what kind of costs they might run into. And it also gives you a graph that I'll show in a moment how those assets grow over time and when they might be needed. I'm going to start just by building out this scenario. So we'll consider this person is 55 years old. They expect family to help them. We know that the average long-term care need is 3 years, and we're going to assume the average need for paid services of about 1 year, like I talked about before. For example, they might need a nursing home the last year of life or something like that. So 1 year paid service, and we'll say that nursing home is going to be $120,900 a year. And we'll assume that paid care starts at age 82. Almost 70% of long-term care insurance claims start after age 80. We're not assuming this person has long-term care insurance, but we're just using that as data to build a baseline so we have a realistic number to start with in terms of when they might need the long-term care. And then we're going to assume a 5% inflation rate on the cost of care. As I mentioned earlier, that seems to be a relatively realistic inflation rate assumption. They don't have anything saved specifically for long-term care, and they want to stay in their home as long as possible. And in some surveys of people 50 or older, over 80% of people have that desire. They want to stay in their home for as long as they possibly can. This is just a screenshot of the calculator with those numbers. So we have their current age, the age that they will need the long-term care, the cost of that long-term care, the inflation rate, the number of years of service, and then we said they didn't have anything saved specifically for long-term care. They might have some assets, but they're not necessarily labeled for the long-term care. They might be for travel or something else. And then at the bottom, there's a button that says show all input. I'm just going to assume we click that. It opens up some savings assumptions down below so we can put in an estimated before tax return of 6%, bit conservative, but we'll run with it for now. Marginal tax rate, 22%, and annual increases in the amount that they're saving, we're just going with 0%. So even if they were saving money towards this need, we're saying they're not actually going to save like cost of living adjustments to their salary or anything like that because they want to travel and buy fun things with those while they're working. So when you click calculate, it will bring up a box of results that looks like this. I'm not going to make you read that. I'm going to break out the important details. It shows that by age 82, this person's going to need $451,375 to cover the costs of long-term care. They could save $8,277 a year to meet that need, or they can save a lump sum of $131,286 now and just let that accumulate interest up until age 82 when they need it. The results also say that you can also consider evaluating insurance policies to help with some of those costs, which is true. We could definitely do that. The caveat that I would add to that statement is that they may or may not qualify or be able to afford a policy that'll cover that full amount. So it's possible they'd need to consider a hybrid approach of insurance and self-insuring or other financing options like home equity or something in that scenario as well. This is the graph that the calculator will show you. It assumes that they are saving some assets over the course of time until the need 28 years later, that last blue bar. And then the orange bar is the long-term care need. So at that point, if they needed to use that money, but then actually needed long-term care for a longer period of time, they would be out of those assets and would have to tap something else. But this gives you a visual that you could share with a client to talk through what those costs look like. But as financial professionals, one of our roles is to help clients mitigate financial risk. So what I wanted to ask all of you is, what risks do we see in this scenario? And I wanted to have you just pop those ideas in the chat if you would be so kind. Yeah, more care than anticipated. Definitely, we're only assuming that 1 year. Man, I was really hoping somebody would point out the chainsaw and the toes there. I'm glad you got that. That is risk. We could assume that that's the client right there, maybe.
That was great.
Yeah, inflation could be higher than anticipated. Expecting family to help, that's the big one versus talking to them. Yeah. 1 year of need. Yeah, exactly. So yeah, savings specifically earmarked. That might be something they've never thought of. Maybe they're a great saver, but they've never thought of the fact that they have to put this money aside to and keep it there until they might have this need. Availability of care, definitely. One of the facts that we're facing now is that there's likely going to be a lot fewer people in the future to provide this kind of care, just because of demographics, the way the demographics of the country are changing. Yeah, most family members want others to care for them. So true. Yeah, depending on only family. Relocation away from family. Yeah, so you're starting to hit on that pretty strongly. And that's one of the things I really wanted to drive home is that family aspect. And the home is not safe. That's one of the costs we didn't talk about. So if somebody wants to stay in their home, there's likely going to be renovations that are going to have to be done to cover or to make sure that they're safe as they do age. And I've personally had family that have done that early in life, just knowing they want to stay and they make those modifications while they have the money. It might have to treat me like a little farm animal and take me out back, perhaps. Yeah. So the big thing to realize here is we really need to talk to family. That's a big one. Bring them in, have a conversation about those realities. They may want to be traveling in 28 years and not necessarily staying home taking care of people. So tons and tons of assumptions can go into these things. If you're talking to a client, make sure you test those assumptions and really get into some details about how they could be impacted later in life. Thanks for playing along on that. I'm going to go into some key takeaways here. Long-term care is the need for assistance to fulfill any personal care need. And this is just in comparison to that HIPAA definition I shared that just focused on activities of daily living. That's a component of long-term care, but it's not the whole story. So somebody might need those incidental activities of daily living covered too. Long-term care is a high probability and high cost event, which says we need to be planning for it. Family can be impacted, so involve them in the planning. We just talked about that a little bit. Plan early while the client is able to make decisions. I didn't really mention that specifically during the presentation, but this is another really important one to consider because for something like a continuing care community, you have to buy into those before the long-term care is needed. And you want to make sure that the client is able to think about those decisions and make those decisions for themselves. That's actually one of the selling points to do some of this long-term care planning early on to give them the freedom of choice. Multiple payment strategies may be needed for a comprehensive plan. We talked a little bit about The fact that one thing like long-term care insurance might not be enough to cover what they actually want to achieve in their long-term care. So you might have to mix and match different options like home equity and other saving strategies. State rules can vary across, state rules can vary for Medicaid. I hit that one pretty directly earlier on. And these are really hard conversations. You want to realize that we're asking clients to face the fact that one day they're not going to be independent, that they're going to need help. And that's a really hard thing to face. So you got to try to frame this in a way that I mentioned a few seconds ago, that we want to try to give them freedom of choice. That's really what this is all about. The earlier we start thinking about this, the higher the likelihood we're going to be able to put a plan in place that's going to meet what they want. And it's going to help save the family a potential huge headache later on. That's what I had for all of you today. Appreciate you listening. And it looks like we got a few minutes for some discussion as well.
Great job. Any questions, anybody? We got
Thanks
a
for reminding me how much it's going to cost when I get older.
You're welcome.
and Honey put in the comments about the fact that a lot of elders are scammed out of their money too. So
Oh, yeah.
something to think about, right? That we need to make sure that their money is in a safe place and they don't give it up.
Yep. Absolutely. Yeah, trusts can be an option for that. Can any of these options be transferable? Paid for myself, but my parent needs to use before me. Oh, that's a good one. I'm actually not 100% sure on that. I would have to do some research. Um,
Depends on
I'm
the kind
wondering,
of account that you're saving your money in, I would imagine.
oh yeah, yeah, for sure. And I'm just curious if, Colleen, if there's one in particular you were wondering about.
Hmm. Do you recommend long-term care? Recommend. What? We don't do that.
Oh, yeah, long-term, since long-term care insurance might be hard to qualify for, what do you recommend? I think that's going to depend a lot on the person's age, probably, and existing assets. There's looking at homes is, I think, a pretty good option, actually, home equity and how that might be converted. However, there's a really strong case to be made for involving family in that conversation too, because that could be a legacy item that they hope to pass on. And I think talking through the pros and cons of that with family would be really important too. But that can be people's largest asset. And I've talked to friends when I've been building out financial plans for them about doing just that, saying you may not have enough assets, but you do have this house. How do you feel about tapping that equity for long-term care, and how would your kids feel about that? And it's a long conversation. But if you're getting into this early enough, it's pretty realistic to save enough to cover these costs. And you can talk about saving strategies, budget strategies and stuff to get enough cash in the bank to cover a lot of this. And I think those hybrid life insurance policies could be something to think about and investigate too. I'm not intimately familiar with them, but if you can get an accelerated death benefit, that might be an option. And they're apparently easier to qualify for compared to long-term care insurance. See, I know we only got a few seconds left. Okay. Oh, I think this is the last question in here. Do I recommend a long-term care insurance? I work in a completely unrelated field to finance. I'm a hopeful career changer, and I don't want to speak as if I'm a professional in this industry. I just would say do your research. Long-term care insurance policies are going to vary substantially, as with any kind of contractual agreement, like I mentioned earlier. And it can be a good thing just because the money is there. As long as you know how much the person's going to be getting, they can rely on it. However, just keep in mind that to qualify for payments, you're going to have to meet that HIPAA definition or a more strict definition depending on the policy. And someone might need services before they actually get to that point. So the incidental activities of daily living, again, think about that and how people might be able to cover those needs.